Thank you very much for being here. Thanks to Agnès. Let me say a few words to start with and to put things a bit in context for actually in relation to our work. Okay, first of all, Agnès, Deputy Governor of the Banque de France. I think she's a regular contributor to the EMU Lab. You came a few months ago and gave the I think dinner speech on fiscal policy, the policy mix, one of our events. Now, okay, this seminar as well as the forthcoming appointments are in the a conducive instrumental to the preparation of what we have called the Florence report. I recall this is let's say the flagship product of the EMU Lab. And the title, provisional but pretty settled, is Reconfiguring Europe in a Fractured Global Economy, Tackling Fragmentation and Expanding Policy Space. So I think what we are discussing today, at least from our a bit narrow viewpoint, should be seen also in that light. And actually, some of the slides that Agnès will show address a bit that kind of point. Now, the issue of adapting euro to the digital age, digital currency, stable coins, crypto are they elicit quite a bit of sometimes emotions also, but certainly different views. I have just, I mean, I'm in one of these, networks and things, so we receive messages and things. So on, without telling you who wrote it, but I just wrote down here a few comments in this chain of reactions. Okay, the first one, I think this is, it was Wolfgang Munschau a couple of months ago, saying in his blog, Euro Intelligence, if you are against stable coins and crypto, you are either a European or a macroeconomist or both. In this blog here, they are mainly macroeconomists and the Europeans, so they are actually, most of them are quite skeptical of, especially on stable coins and crypto. Let me start with the first one, which instead is in favor. So it looks like the train has left the station and we Europeans are still asking ourselves where it is going and whether we should buy the ticket.
Who's they saying
that? That you can, I don't tell you. Maybe I tell you later. Okay, this led to a flurry of reactions. The US has fallen to the crypto lobby. That explains it all. Whether you wanted you wanted a particular train depends on where you wanted to go. In the US, the train and the intended destination are owned by the crypto bros. They pay big bucks for it and get even bigger bucks in return. Another one, the fact that heroin has become fashionable is not a good reason to take it. Some things are just poison, however profitable they are to supply and powerful their patrons. And I think that was my last, but I could have continued along the same vein. I think with this small introduction, just to whet your appetite, we give the floor to Agnès, who is going to make the initial presentation. Then Leonardo Melosi from the Economics Department will offer some initial reactions, and then we open the floor. Okay, Agnès, thanks again for being here. By the way, you probably know the ECB Governing Council is meeting in Florence these days. So Agnès, after this, after the enjoyable part, which is this one here, she goes for the duty.
Thank you, Marco. Thank you for organizing this seminar. It's really, it's always a great pleasure to come here and the scenery is just gorgeous. The academic stuff here is so interesting. So interesting to have these discussions. I'm really happy, and especially on this topic. I must say, I joined the central bank only 2 years ago. And at that time, so I come originally from academia, and I had no idea about this topic I'm going to talk today. So I only have perhaps little advance compared to many of you. So I'm very much interested in your reactions. And I think macroeconomists should get more involved in this, because this is very serious. And there is a tendency to talk about these digitalization, these stable coins, CBDC, and so on, either in a technical way or in a completely political way. So we need really to bring economic theory in that. And so I'm very happy to have this discussion. And please don't hesitate to interrupt me. It's interesting also that we talked about trains, because this is a comparison that is often made between stable coins and trains. But I think, and I will come back to that, the story is more and more about the tracks rather than the trains, which is even more serious. Okay, so I thought maybe a good way would be to start with the current payment system and to start with the basics of the basics, and then move to tokenization of assets, tokenization of the currency, and finish, which will be the third part of my talk, the implications for the international monetary system. So let's start with the starting point. How do you pay? So I'm not going to survey all of you. How do you pay? There are, of course, many ways of paying at point of sale, or to make transfers, person to person or business to business. Some of them are also stores of value, but not all of them. And this is something that people tend to not always understand. If you pay with a card, there is no money in the card. Well, it can be a prepaid card. In that case, there is money in the chip, but usually it's just the card will instruct your bank to take the money and to give it to the bank of the deposit of the merchants. So it's a payment system, it's not a money, okay? So in terms of monies, we have, of course, here the euro, which is both, so the euro in the form of cash is both a means of payment and a store of value. We have bank deposits in euro, so cash is a liability of the central bank, whereas bank deposits are liabilities of commercial banks. Hence, we say that cash is central bank money, whereas bank deposits are commercial money. The convertibility between cash and deposits is ensured at par. There are guarantees, deposit guarantees up to a certain level. And the euro is a legal tender in the euro area. A merchant cannot refuse your euros. There are also foreign currencies, exactly the same in foreign jurisdictions. And for us, European, the exchange rate is not parity, which is something that also people tend to forget about stable coins. And then you have the crypto asset word. I said crypto asset because one question will be whether we can talk about cryptocurrencies or only crypto assets. So here you have different categories. The first generation were like Bitcoin, very volatile. And now we have the second generation, which are stable coins, which are backed by liquid assets in one currency, generally the dollar. There is no legal tender. You can come with a stable coin in a shop and they can refuse. And of course, you cannot pay your taxes with crypto assets. And then I will not talk about it. You also have local currencies, which have developed in many places. They are not universal in the sense that generally they are designed with a precise purpose. So these are conditional currencies in the sense, for instance, that you have a currency which can be used only in a small perimeter, local perimeter. And it's also melting currency in the sense that if you don't use it before a certain date, the value diminishes. So this is an incentive for local activity to be vibrant. Okay, so you know the three functions of the currency: unit of account, medium of exchange, and store of value. And the three desirable features, which are easiness to use with low cost and high speed, stability, and trust. And we concentrate on trust at this stage. And move to a recent paper by the BIS, which it was in the annual report of the BIS this year. And what they do is that they translate this issue of trust into three desirable features of the currency, which are singleness, elasticity, and integrity. And this is extremely important for the tokenization of the currency. So singleness means that money is information insensitive. So agents can use the currency, the money with no questions asked, so without any due diligence. In the current system, commercial money is settled at par against the central bank money, so is as good as central bank money. So we have singleness. Elasticity means that money can be provided when needed, in a flexible way, either by the commercial bank that extends credit, or by the central bank and can refinance the bank. So in practice, if I want to make a transfer to you, and I ask my bank to make the transfer, and the bank doesn't have the liquidity, it can ask the liquidity to the central bank. So this is the elasticity. The central bank will provide the liquidity wherever it is needed. So we have a two-tier banking system. And third, integrity, a monetary system that is open to widespread abuse, from fraud, financial crime, and other illicit activities will not command trust for society. So we know that the crypto world is very much prone to fraud, to illicit activities, money laundering. And so this is a worry, and this is where the two-tier banking system is also constructed on, with banks having to do the know your customer compliance. This is why you receive forms to fill from your bank, where you need to explain where the money comes from. And so they have the right to ask you all these questions. This is part of the screening of the customers, and they also screen the transactions. Sometimes you may receive a phone call from your banker, say, oh, you had this transfer, can I know a bit more about it? So this is a know your customer checks. You want it? Yep.
Sorry, yeah, just a quick question. Is there a reason why you leave out something like money market mutual funds, right? Because money market mutual funds arguably are already a source of deposit-like instrument that doesn't quite fit that structure.
Very good. Money market instruments, so you cannot pay with an MMF.
I mean, in the United States, you can have a Visa card on your MMF account and you just pay with it.
It's not linked with deposit accounts?
No.
Okay, so it's like a remunerated deposit, but it's a MMF that is issued by a bank.
No, it's issued by a non-bank financial institution.
Yeah. So this is also one point I wanted to make, is that we already have this kind of thing, even before the story of stablecoins, etc. We have already some payment systems that are based on a pre-funded pool of money, like PayPal or or you have a pre-funded cards also, or apps, fintechs that receive your money, can remunerate and offer a means of payment. So this already exists. It's a teeny part, well, at least in Europe, maybe it's more developed in the US. So one very important feature for singleness in the two-tier banking system is that we have two contact points between commercial money and central bank money. And to make it concrete, suppose that Marco and Leonardo have gone for lunch together. And Leonardo paid for the two. And now Marco wants to reimburse Leonardo. So Marco can pay with cash. So how to do that? He will go to an ATM and withdraw cash from the ATM. So he will instruct the bank to provide the cash and to take it from to debit the deposit account. And if the bank doesn't have the cash, the ATM is empty, the bank can ask the central bank to provide the cash, and then the central bank will debit the reserves of the bank at the central bank. So here you have a contact point between cash and commercial money. Marco has received cash in exchange for commercial money at par. You never thought that maybe when you ask 100 euro, you are debited 110. There could be some fees in some cases, but
not going to for lunch with Leonardo anymore.
Okay. So Marco, you may decide. Oops, sorry. You may decide to pay to reimburse Leonardo through instant payment with tips. You know, you can make a transfer. So then what you instruct your bank to make a transfer to Leonardo. So the bank will channel the transfer through target 2, which is the interbank gross real-time system. And so the bank will debit your account and will credit the account of Leonardo. And here you have a contact point, which is between the commercial money, so the reserve, the account you have at the bank, and the reserve of the bank at the central bank, in the sense that the transfer within target 2 will be made in central bank money, not in commercial bank money, in central bank money, and again at par. So now stablecoins. What are stablecoins? So they are crypto assets that aim to maintain a stable value against one currency. It could be a basket of currency, but in practice it's one currency. I'm leaving aside algorithmic stablecoins, which actually are not stable. So I'm concentrating on these kind of stablecoins. And the stability is ensured by a reserve of assets. In a sense, for those familiar to international monetary issues, it's like
Currency board.
Yes, it's like a currency board, except that in this case it's private, whereas a currency board is a central bank that backs its currency. It's also the central bank currency with assets, liquid assets in a foreign currency. So the reserve assets mostly include very liquid assets, assets that can be sold in order to extend the liquidity to reimburse the customers. So same for MMF. If you want to make a payment, the MMF may have to sell some assets to give you to allow you to make the payment. So what are today's? So stablecoins almost didn't exist in 2020, and now it's about a little less than 250 billion euros worldwide. So very steep increase, still relatively modest. I will come back to that. So what is the main use case today? I think it's a very good paper just published by the ESRB on crypto assets. And I think they estimate something like 90% of the use cases is just a way to enter the crypto asset world. So it's a way when you have a commercial, you have a deposit in a commercial bank, you want to buy, say, Bitcoin, it's a step, it's a gate towards crypto assets. But why are many people so enthusiastic about stablecoins? Mainly for two reasons. The first one is that stablecoins could be used as a settlement assets for financial transactions. So today, there is a movement of tokenization of all sorts of financial and even non-financial assets like real estate, which means that these assets are put in the format of a token, so in the format of a code, lines of code that will travel in a distributed ledger, so it's a blockchain, so with blocks. And what is nice with this is that it is very efficient. You no longer need all sorts of intermediaries, so that it reduces the cost, transaction costs, very useful for the capital market union. And it secures also the transactions because they cannot be changed once they have been introduced. And you can also plug some what is called smart contracts that will, for instance, if you have indexed bonds or green bonds, which could deliver a return that depends on some action, it can also deal with these conditional payments. So very interesting as a technology, and it is developing in the financial world. So the assets, which can be MMF, it can be bonds, it can be all sorts of assets, are put in tokenized format and more easily exchanged. It's also interesting because you can cut it in very small pieces. So, for instance, you want to buy a bond that is 4,000 euros. You can ask for only 1/10 of this. So it's very easy to do. It's also very interesting for firms because it's a way also to know who owns their bonds, who owns their equity in real time. So it's really a very promising technology. The problem is that if I want to buy a tokenized asset, how can I pay? So I'm going to pay with cash? No. I'm going to pay with central bank wholesale. So if I'm a bank, I can pay with my reserves at the central bank, but this is not on the blockchain. So banks are developing stablecoins also to exchange tokenized assets. So I'm a bank, I buy tokenized assets from another bank and I pay with a stablecoin, which is also on the blockchain, which allows for what they call atomic settlement, which means that the delivery and the payment are simultaneous, completely simultaneous, which erases the counterparty risk of the transaction, which is very interesting. So the second use case that is envisaged is for cross-border payments. So it's very useful for I don't know if you know the system today for cross-border payments is very heavy. It relies on correspondent banks. So if you're in a country, you need to find a correspondent bank, meaning a bank that has a correspondent in the target country. And if not, then your bank will need to liaise with the correspondent bank to make the transfer. So it's a bit long, lots of intermediaries, operational risk, because you need to reconcile and to check at each step. And also because the correspondent bank are doing the due diligence about but you need to coordinate across countries. So it's very, very heavy and extremely costly. The G20 has program to cut the cost of cross-border payments, especially remittances, which can be extremely costly for the workers. So these are the main use cases. Most people don't think that these stablecoins will be ever used for day-to-day transactions. You go to the bakery, you're not going to pay with the stablecoins, although Visa and MasterCard are already working on including stablecoins in their schemes. So you probably know that stablecoins have been regulated. The EU has the reputation to regulate faster than it innovates. So it was the first to introduce the MiCA regulation, markets in crypto assets. It was in 23, and it started to apply, I think, this year, or 20 in 2 steps, in 24 and 25. So you have the main elements of the regulation on the table for MiCA. So the reserves of the issuers of stablecoins need to be in liquid assets, but more than that, at least 30%, or for big stablecoins, 60% of the reserves need to be in deposits in bank accounts. So here you see the connection with the commercial bank. And the rest needs to be in high quality government bonds. There is an additional requirement in terms of concentration limits. You cannot put all the reserves in the same bank. Otherwise, you create.
Here, this is for the crypto or stablecoins?
Only stablecoins. Only talking about stablecoins.
Yeah.
There is a concentration limits. You cannot put all the reserves in the same bank. Otherwise, you create a risk for the bank. Look at SVB, what happened in March 23, 3.3 billion, I think, of cash, billion, sorry, I need to check. 3.3, yes, billion of US dollar was deposited by Circle in SVB. And so this created a run. So there's a requirement for issuers to distribute their deposits in several banks. There is also a capital requirement for non-bank issuers. So the stablecoins can be issued by banks or by non-banks. If they are issued by banks, banks are already regulated with capital requirements. But if they are issued by non-banks, then capital requirement will apply. Interest payments are prohibited both for issuers and for crypto asset service providers. So what are crypto asset service providers? The platform that will allow you to store your stable coins and exchange for other assets or other stable coins. And the redemption in fiat currency needs to be ensured at any time without fees. Now, next July in the US, a regulation was also, so before July 2025 in the US, stablecoins were already issued, and either they were not regulated or they were regulated at the state level. So the regulation, the federal regulation was really welcome. But it's a bit different from, so the general philosophy is the same as MiCA, but then there are important differences. First difference is that there is no requirement to have a portion of the reserves in deposits in banks. It can be fully only treasury bills. As a matter, so today it's about 60% in treasuries. And there can be some other liquid assets like money market funds in the reserves. There are also concentration limits. There will be concentration limits set by supervisors when they decide who will be the supervisors, because this has not yet been decided. And so the supervision and the regulators, so there is a fight between different institutions. You know, in the US, there are many different pieces of supervision, and there are still competing bills on how to set this. In terms of interest payments, it's prohibited for issuers, but nothing is said about service providers. And actually, we've seen already some interest payments made by the platforms, in the sense that you can bring your stablecoins to a platform, and the platform and use it as collateral. The platform will use it as a collateral to borrow and to offer you a product that yields a return. And finally, the redemption needs to be timely. What does it mean? Timely. And there is no explicit prohibition of fees. And actually, we've seen that there can be some fees and some gates, some delay to reimburse the owners of these stablecoins. Yeah.
Yeah. Sorry, the reserve requirements, are they in the case of MiCA in euros, or can that be Swiss francs, the government bonds? Because the Genius Act says explicitly only in US dollar, right?
So if the stablecoin is in euro, it needs to be in euro. If it's linked to the euro, it needs to be in euro. If it's linked to, but it can be linked to the dollar. So it's possible to issue a stablecoin in dollar in the EU, which raises the question of regulatory arbitrage, because, say, Circle is both issued in the US under Genius and in the EU under MiCA. And if they are fungible, then you can issue a stablecoin in the US, and the owner of the stablecoin will go to the EU to get redemption, which is more, there is more protection, consumer protection in the EU than in the US. So then there is a risk that the reserves that were set in the EU are extracted to reimburse some US holders of stablecoins. Okay. What is important also is that in the EU, the supervisors, who are actually the bank supervisors, they have the possibility to limit the issuance of stablecoins in non-euro. And there is currently a bit of a discussion on whether they should use this right to limit the issuance of stablecoins in dollar. So what is the problem with the stablecoin? The problem with the stablecoin is that there is no direct contact between the stablecoin and central bank money. So here again, I'm sorry, Leonardo and Marco. Marco wants to reimburse Leonardo. He can reimburse in stablecoin. So he will ask his bank to debit his deposit account and to credit the deposit account of Circle. So I make it simple with the same bank for Circle and for Marco. And so to credit the account, the deposit of Circle at the bank, and then ask Circle to credit the wallet of Marco in stablecoins. And then Marco can channel the stablecoins to the wallet of Leonardo. So this can be very efficient. Platforms sometimes can impose some fees, and the fees can be quite high, in fact. So, and not so easy to do the transaction directly, because then you need to record a very long key, and it's quite difficult for people who are not professionals for crypto. Now, the question is Leonardo happy with the stablecoins? And so the question is, so I was a few weeks ago at the Eurofi conference in Copenhagen, and there were fintech and crypto issuers around the table and saying, well, once you have stablecoins, there is no risk any longer. You say, oh, yes, there is no, because of atomic settlement. So atomic settlement eliminates the counterparty risk. But then you are left with stable coins. And the stable coin is stable until the day is no longer stable. And secondly, how to redeem it? Not so easy. You can, if you are in normal times, it should be okay. But now I show you so the volatility of stable coins. So here you have this taken from the ESRB report I was mentioning before. So the first graph on the left is the annualized standard deviation of daily return of against the dollar of the Bitcoin, stable coins, and SP50. And you see that so Bitcoin has a huge volatility, everybody knows it, but stable coins can have, well, it's not zero. The volatility is not zero. So remember, they don't yield a return, so it's only the exchange against the fiat currency. Interestingly, the yellow dot is the mean. It's outside the interquartile range, which means that there are extreme events that move the mean, so it's asymmetric distribution of volatility. And there is an example on the right-hand side of such volatility, which is around the SVB failure in March 23. When it was disclosed that Circle had held $3.3 billion in reserves with SVB. And immediately, in just 3 days, there were 3 billion redemptions. 3 billion redemptions of Circle stable coins just in 3 days. And the value fell up to 0.85 dollar instead of 1. So singleness was broken. One stable coin was not equivalent to 1 US dollar. And then there was a contagion because the stable coin was used as collateral for other instruments. So there was some contagion within the crypto system. Another stable coin, so the Tether, so USDT is Tether. So the two main stable coins are, the first is Tether, which is the blue line, USDT. And the second is Circle, which is the yellow one. DAI is the stablecoin of Ethereum, which is blockchain. And so there was a positive contagion, so a positive externality, because the withdrawal from Circle, some of them benefited to Tether. But you see, so that there can be some volatility, especially in stress time. And actually the correlation, so some people have also calculated the correlation with stock markets, and the correlation actually is positive. So it's not even a diversification asset.
So we have a basically quite stable apart from the moment in which it's not safe, which is
okay.
so that for the rest, apart from that episode, it is volatility is contained, no?
But there is some volatility. It's not one. It's for the issuer it's one, but then it goes on the secondary market in platforms, and the platforms may set a price that is slightly different from one. So why are most central banks cautious about stablecoins? If we come back to the BIS trinity, singleness, elasticity, and integrity. So I think we can explain most of it through this trinity. And in practice, so in terms of consumer protection, there is a risk of depegging, which we've just seen. And in case of a depegging, so suppose that the stablecoin is widely used as a means of payment in a country. If there is a depegging, what would consumers say? They would complain about to the central bank. What did you do? The central bank is supposed to ensure a stable, trustful payment system. So this ambiguity on what is a stable coin, is everybody aware that there is no guarantee whatever and the central bank has nothing to do with it? Is that something that is sustainable? Second, monetary policy. So to the extent that stablecoins would be issued by non-banks, then you lose the elasticity, hence you lose one channel of monetary policy transmission through credit. Third, financial stability. Most people focus on this. The most obvious one is fire sales in case of a run. If there's a run on stablecoins, then the issuer needs to sell the assets, and the assets are supposed to be liquid, but we know that liquidity is something that may change over time, and liquidity may collapse at some point if there is a stress in the market. And the price of the assets could also contribute to some contagion to the traditional financial system. So there is no lender of last resort for those issuers that are non-banks. If the issuer is a bank, it's less of a problem because the bank has the reserves, can use them as collateral to get the refinancing from the central bank. But there are other issues concerning financial stability. Cybersecurity is one. So, and this is especially the case since there is a huge market concentration with the two main stablecoins counting for the bulk of the market. Reliability of exchange platforms. We've seen in October 10, just after Trump announced another round of tariffs. There was a panic in the market concerning everything related to crypto due to the possible shortage of rare earths that would spill into the lack of chips and the IT systems. So there was a failure of some platforms, including Binance, which could not pass the transactions. And so there are cases, now it's being taken over by the courts because some investors lost a lot of money due to this failure of the platform. These platforms are not regulated, supervised as banks, insurers, pension funds, money market funds, etc. And finally, international spillovers amplified by regulatory arbitrage. Once we have, if we use the stablecoins that are issued in another jurisdiction. Fourth problem is what we could call a crypto dominance with reference to fiscal dominance. The fact that the central banks would in fact be forced to be the lender of last resort or the buyer of last resort in case of a run. This is not pure theory. Last week, I think Chris Waller, member of the Fed board, suggested that the Fed could open master's accounts with limited reach for non-bank issuers of stablecoins. He made clear that this would not be to lend to them, so they could not borrow from the Fed, but still they would have a master account. So he called that a skinny master account. So it was at this stage, it's just a suggestion he made. But we see that there are already some thinking of giving issuers of stablecoins access to a positive account at the Fed. But then the next step could be, why not a negative account? Why not borrowing from the Fed? And then what's the difference between a bank and a non-bank? Is it just a regulation? So we have a problem there. And finally, stablecoins are a gate to crypto assets. We see that they could move. When there is a lot of action in crypto assets, there is also a lot of action in stablecoins. So there could be some spillovers from unregulated crypto assets into stablecoins.
Money laundering?
Money laundering, I talked, yes, this is part of what I call cyber security, including fraud and money laundering, terrorism, financing terrorism, and things like that. And finally, the risk of dollarization. 99% of stablecoins today are in dollar. So it's kind of proxy of the dollar, which could be very attractive, especially for some emerging and developing countries, where it's more difficult to get dollars, and it could be easier to get these proxies of the dollar. Less the case in the euro area, but you never know. We need to get prepared for that. So now I wanted to say that innovation doesn't stop with stablecoins. This is just one possible use of DLT, but there are many others. First, in the private sector, private money and liquid assets, there are stablecoins, but also there is a lot of actions also in the banks to develop tokenized deposits, so to tokenize the deposits. And here the use case is quite clear. If you have a multinational company which has a bank account in different jurisdictions, with liquidity in the different jurisdictions, having those deposits tokenized will help very much in cash management, which may make it much more efficient, rapid, etc. So this is a service that the big banks want to provide to their big corporate customers. There could be some other. So what's the difference between a stablecoin and a tokenized deposit? The stablecoin is a bare asset. So if I give you a stablecoin, this is yours. And it's like cash. Whereas tokenized deposits is like a deposit. If I want to give you the deposit, I need to ask my bank to give you the deposit. And in a sense, stablecoins, for me, who's already a bit old, it remembers me the travelers checks we used when I was a student. We would travel with travelers checks. So I would ask the bank a travelers check, and then I could use it I could have it redeemed in any banks, any bank, so which is very practical. You don't need to go to a correspondent bank. You can go to any bank. And so it's a service that the banks could offer to their customers, very useful, but not a huge use case. Whereas tokenized deposits, and I must say that over the last 6 months, the enthusiasm vis-a-vis stablecoins has a bit backtracked, whereas tokenized deposits, there's now a lot of action in terms of tokenized deposits. So we don't know, and of course they tokenize market funds, money market funds. It could be also in euro. MiCA allows it to be issued in euro, and it's safer. So less interesting for the issuer, because the issuer, the business for an issuer of stablecoin is very good. You issue something that bears no interest, and which is backed by assets that bear an interest. So in a sense, it's a privatization of the seigniorage of the central bank. The MiCA allows to do this, but with some stricter conditions than in the US. Now, in the area of wholesale payments, in the euro area, there is, how much time do I still have?
Yeah, what time is it? I think, okay, 10 minutes, yeah.
Okay, so I accelerate. In the area of wholesale payments, so we have said that banks can exchange tokenized assets and settle in stable coins. But the idea of the Eurosystem is to provide the central bank money in tokenized forms, so as they don't need to use stablecoins, which is a bit risky, as we see. So to emulate the current system in a tokenized world. So to make it clear here, I think we have the legacy system, which is a two-tier system with the central bank providing central bank money and commercial banks providing commercial money. And in a tokenized system, we have commercial banks that provide tokenized deposits, stable coins, whatever. And that could be a central bank. The central bank could also provide the central bank money in tokenized form. So this is what is called the contest project, where the Eurosystem will be supplying central bank money on a blockchain next year. At the end of next year, it will start. This is the first step. And in the longer term, the idea is to provide the rails for tokenized assets, tokenized commercial money and tokenized central bank money to circulate on the same rails. And today what we are seeing is a big push of private firms, big firms like Google, who want to also privatize the rails. So this is something that we need to watch very carefully, because at the end of the day, there could be some fragmentation of the liquidity if you have different rails that do not operate together. On the retail payment, so I didn't talk so much about the digital euro. So you could pay Leonardo also with a digital euro, which is the equivalent of a banknote, but in the digital form, which ensures singleness and anonymity, which is something also that is valuable. You know, when you pay with a credit card, it's not anonymous. The banks knows everything. Okay. When you go to the ATM, you get cash. The bank knows that you've withdrawn 100 euros, but then you can do whatever you want. The bank doesn't know. So this is the same idea here. You withdraw 100 euro of digital euro, and then you can use it offline anonymously. Tight link with bank deposits, because the banks will be offering a cash, a fast payment system as today, but also digital euros. So keep the customers with them, offering all these. We see this as really positive to keep a two-tier system. And to multiply the means of payment, to introduce more competition. I didn't have the time to talk about this, but there is a duopoly that exploits the rents. Also to have more resilience, because it could be that one means of payment doesn't work someday and you have alternatives. To exploit network externalities, having the digital euro legal tender, then you can fight more easily the incumbent firms that have built these network effects over time. A fully European solution that doesn't depend on foreign powers that could cut you off at some point. Platform for innovation. So this is an interesting point where the ECB is running an innovation platform where fintechs, so 70 players, including fintechs, banks, etc., and asking what they would think about in terms of innovation. And the most interesting case, I think, is to plug some systems to have some conditional payment. So, for instance, you buy a fridge, a new fridge, and the payment will be programmed when you buy the fridge, but triggered only when you have received the fridge, actually. So this is quite interesting. And also, so this is not in the area of tokenization, but interlinking fast payment system. The Eurosystem is very active in interlinking the European fast payment system TIPS with foreign fast payment systems to get instant cross-border payments. There is also innovation by banks with the Rio Europa system, where now you can make a transfer, an instant transfer, just with a phone number with someone else, but not yet reunified at the euro area level. We have two, Rio in the north, Europa here and in Spain. And well, there needs to be some interlinking of the two. So a lot of action aside from stablecoins. And now let me finish with the international monetary system. What does it change? Most people would say, so I'm simplifying, most people would say that, of course, stablecoins are reinforcing the international role of the US dollar. And this is exactly what Trump wants to do. So why? Because of the expansion of the US dollar through transactions in stablecoins, which we said is a proxy for the dollar. And then if these stablecoins expand, then naturally people will hold them. So it will be also a store of value. And they have confidence, have trust, because they know that there is a backing by US dollar linked by liquid assets in dollar. And so the credible peg of stablecoins to the US dollar make it also a firm unit of account. The problem is that, so there is an alternative, story, which is that if you cut the transaction costs, then the dollar will no longer be necessary as a vehicle currency. You know now that when you want to exchange currency A into currency B, it's cheaper to go through the dollar. But if you cut the cost of exchanging currency A against currency B, then why go through the dollar? So if and this is actually what is happening in Asia. They have a Nexus project where the CBDCs of the different countries will be exchanged, and one against another without the use of the dollar. So if the dollar loses its role as a vehicle currency, then it could also lose its, weaken, it's not going to lose, but it would weaken its role as a store of value also. All the more that it doesn't provide an interest and the value is not guaranteed, so it's not so much a unit of account. And then you have also the unsustainability of fiscal policy in the US. So what is worth, so if the reserves are all in treasuries, what is the value of the reserves? So far it has been favorable to the US dollar, but I don't think this is the end of the story. It could morph into something different with diversification of the international monetary system, which I think would be stabilizing. However, I make a big difference between a multipolar IMS and a fragmented IMS. So it's very important if there are different currency blocks that are interconnected. So I take just one example. Suppose there is a negative shock on the world demand for US goods and services, then the dollar should depreciate to, why? Because it will be a way to finance the deficit, the trade deficit, because if the US dollar depreciates, then the assets become cheaper, so there is more demand, so there is capital inflow financing the deficit, and also, of course, because it makes US goods cheaper, so this will reestablish the balance. However, if the IMF is fragmented, if there are large transaction costs to buy some US goods or the US currency, then it could be that this doesn't work. So it's no longer stabilizing. So I think that a multipolar system could be stabilizing because there is more absorption capacity in case of an imbalance. But it's no longer the case if the international monetary system is fragmented. I think I can stop here because I spoke too much, and I can go back in the discussion.
Okay, thank you very much, Agnès. I think very interesting, and as I had anticipated a bit, especially the last part connected with what we are working on. Okay, Leonardo.
Thank you, first of all, to invite me to discuss this interesting material presented by Agnès. It's great to be here, and I'm a macroeconomist, so it's been said macroeconomists are not interested in this type of topic. I am, and I think it's important to bring the macroeconomic perspective or approach to understand these dynamics that will affect the international monetary system, and they are real. And so I think macroeconomists can do a real contribution to provide an angle to these type of developments. I'm happy that can I have the please? Thank you. Maybe that, our presentation kind of complemented because I'm going to focus more on the third part that you has less time to spend. So I think that will be very useful for the audience. So my take on what you present in the third part, and you went a little faster than in the previous two parts, is that, your view is that somehow that, and which I share, that the attempt at least of the Trump administration to launch stable coins as an actual currency, a potential currency for exchange, is that he has to reinforce dollar's dominance in a sense, and for sure to lower the cost of issuing US government debt. However, the other point that Agnès raised is that central bank initiatives like digital euros can also be an important part of the story of this technological revolution, which is the tokenization of money. And by leveraging this new technology, it's possible that the creation of a multipolar. That was not part of the presentation. Are not shared online. Okay, you're right. That's good points. Let me try to share them now. That should be better now, right? Okay, excellent. Thank you. So the quick question, the key question I think that Agnès asked, and of course very hard to have a definite answer to this question, is that this technological shock, this technological shift that you are observing is enough to change the international monetary system, and how? Okay, we're going to go to the last slide was about a fragmented system. We have different islands, trade with different money or currencies, or we go to something more integrated, but still based on multiple key currencies instead of having only the dollar as the dominant law, which align better with the recent geopolitical trends and economic developments. This is my take. So I agree that stable coins are kind of so I follow the tradition of European macroeconomists, so not really like stable coins very much. It's not about liking or not, but I think it's a risky patch on the dollar's waning dominance. That's what they are, particularly because they sit on a very perilous fiscal situation. They are bringing this macro perspective that the fiscal situation may lead to inflation, surprise inflation that can not be good if you characterize a key currency that has to provide store of values. You don't want to have inflation that debase or reduce the value of the key currency. Okay, so these two combinations, in my opinion, makes actually stablecoin quite dangerous and potential as Agnès shows in a particular case of the Silicon Valley Bank, but in more serious financial stress, they can generate potential for amplification of a financial crisis. The growth of Euro-backed stable coins, in my opinion, require a development of a liquid Eurobond market. And that's, again, I bring in the macro perspective to make the point that Eurobonds can be really important because the stable coins business, the issuer, they need to buy liquid stuff, liquid assets. Some is cash, and some of this is cash. Other asset may be short-term treasury bonds or government bonds. And now in the situation in the euro area that there are several options, but there are also these assets are not traded equally. They're not treated as identical assets, and this creates spreads that are not consistent, in my opinion, with the stablecoin business, because what you want to have on the asset side of your balance sheet as an issuer is really something stable in all states of the world. These things are not diversifiable. You cannot really lower the risk. Risk has to be zero in all states of the world for the things to work. Plus, there is an issue that Agnès underscored, which is very important. This is really a currency board. There is no insurance of one-to-one convertibility with central banks reserve. Okay? And another important point I want to make is that we don't have to, so this technology that are available, this tokenization technology are fascinating, are interesting, and they're going to most likely change the international monetary system. But we should not forget about the fundamental. Fiscal sustainability issue is still crucial, and for me is one of the major concerns going forward in many economies, and primarily the US. Fiscal fiscal situation in the US is very dire. There's been the recent fiscal expansion during a period in which the economy is very strong, which add to the concern about fiscal sustainability in the US. The EMU, the Euro can provide an alternative here. I think the situation is much more stable. There's a fiscal framework and it is in place. However, the Euro area has a problem with innovation and growth, which is intertwined with fiscal sustainability. Economies that don't grow, they have problem. They may have fiscal problem. It's harder for the Euro area to adjust the fiscal situation. So another thing that probably that is missing in the Euro area is a market of Euro bonds that also should require to be liquid, because it's important to be liquid, perhaps requires some part of stock mutualization, not only a flow creation of Euro bonds. No Euro bonds built on flows, but also Euro bonds built on flows, and at least partially on some debt mutualization or stock mutualization, sorry, debt mutualization. And so the key question I think I want to discuss a little bit is, can the euro become the working currency? What are the hurdles that may prevent the euros to become, or at least one of the key currency in a multipolar system? And stable coins, again, as I said, that they're, in my opinion, a risky patch or a gap stop on the dollar's waning dominance. And the question that can, however, become a catalyst for multipolar AMS. And then I give you some perspective on what I think is going to be the IMS in the future. So going back to the euro, so the euro can really become a reserve currency. In my opinion, there are several considerations to make. First of all, in a saving gap era, it's very important that the issuer of key currency, somehow the key currency is based on a very liquid, risk-free assets, short-term government bonds. And that's something that is missing the euro area, in my opinion. So there are assets, security, government security issued by some European government that are even safer in principle than the US, for sure, but they lack the scale to become a relevant asset for to back a potential role of euro as a key currency. And it's very hard to believe, in my opinion, that if the strategy for euro to become a key currency is really the strategy of playing the strategy of the stable coins, euro-backed stable coins. Again, it's very important to have markets, Eurobond markets that is liquid enough to support this. Another, you didn't have time to talk, but I like very much about your previous speech that I have the opportunity to read before coming here, is this idea of interbank CBDC that can reduce, defragment the money market in the euro area. I think Alex wrote a lot about this. I think it's very, very good intuition that interbank CBDC can foster more integration in the European money markets, which is essential to support the euro in this conquest of a stronger international status. Stable coins, I don't want to say much more in the interest of time, also because Agnès said already a lot about this, but also very concerned the stable coins combined with a period of fixed situation can actually be more a factor of instability than a factor of stability, a factor that can contribute to a multipolar international monetary system. What I want to conclude with some thought about the current situation. Again, I want to bring in the macro perspective to understand why we are in this situation we are now, and what the situation we are now help us. Whether the situation where we are now, from a macroeconomic point of view, help us understand where we are heading to. So the situation, in my opinion, the decrease of the dollar is irreversible for different reasons. For geopolitical dynamics, rising of other economic powers like China, India, and the euro area. In addition to this, the US fiscal situation threatens price stability and may undermine the dollar credibility as a global store of value. That's an important fact that needs to be always taken into account to understand why we are in this situation and where we are going, and why we need an additional, or why we need to think about to think beyond the US dollar as a key currency, international key currency. Also, the polarization, the political polarization in the US also may have an effect of eroding trust in US institutions and weakens confidence in its governance and leadership. That also is a factor that is weakening the status of the dollar. And so the system is still based on the dollar, in my opinion, because there's currently no available alternatives or no viable alternatives for the reason I mentioned. The euro area is very close. I think euro is is next in line to substitute the dollars, but still there are some reforms to be made. And Agnès, in her presentation, also in her contribution, talk about a very important direction to which we can strengthen the euro and the stature of euro in the international monetary market. But tokenization may offer soon, alternatives to the dollars, and also policymaker activism. So the fact that we are trying to think, so the ECB and other policymakers try to think in terms of issuing their own digital currency may help to create a viable alternative to the dollars. My opinion, the next international monetary system, I tend to agree with Agnès to some extent, I mean, maybe multipolar, right? Reflecting broader shift in geopolitical and economic power. However, CBDC and stablecoins could contribute to multipolarity and give the euro a relative edge only if the EMU's fundamentals remain credible. Because all these things about technology is fascinating with these things about technology, but we never have to forget the fundamentals are important. Trust, I think Agnès said something at the beginning. Trust is key. As trust shifts, the system shifts. So we really need to important that we build trust, and we cannot build trust only with technology, but we also need fundamentals that are in order. And so it's very important that the process of fiscal stabilization, potentially creating a market of Eurobonds, investing fostering innovation in the euro area, are all dynamics that are instrumental to the construction of a stronger euro in the international monetary system. Non-sovereign digital currency is something I start considering myself as a possible venue for research. So that would really damage the monetary sovereignty. Maybe is a dystopian scenario. But what if a non-governmental issuer of digital currency with some characteristics, some protocols that is more trustworthy than the institution may replace currency? This seems like a very remote. I don't think we are there yet. We are not even close. But we don't know if we ask this question with a 10 or 15 year horizon. Maybe the answer is a bit more uncertain. And again, I want to reiterate the importance that the ultimate success of an order depends on factors like fiscal sustainability and the existence of a deep liquid capital markets that, in my opinion, European policymakers need to, especially about the second point, to think very much carefully about. Thank you very much.
This is one of the elaborated in the context of thinking about the narrative of the Florence report, basically collapsing 80 years, 80, in one table, looking at the evolution. So we basically move from this complex long period of multilateral cooperation in the Bretton Woods shadow, even though obviously we have the the Nixon shock, etc. there, but so multilateral cooperation, no free capital mobility, but free trade. Then we move down the hyper globalization on the ESCS, the Brussels, Frankfurt, Washington consensus market unleashed, and then since actually the first, but it started even before, but accelerated in the first Trump administration. It was not reversed at all during the Biden, and now even more. So we had let's say the erosion of free trade, but still with free capital mobility. Now the question related to the talk of today is what happens on the last quadrant. So in a sense, what you have here is that if you can take the two stories, coming from Agnès, qualified by Leonardo, so you can either move to stable coins actually helping what has been called the great monetary bifurcation. So in a sense, you had the central bank digital currency is being pursued in Europe and in other central banks. And in the US, actually going to the corner solution the opposite way, because they have banned the central bank digital currency and they go straight for the stable coins. So if you take a story of two systems actually not communicating, then you have the great bifurcation here. So in a sense, what that would contribute, if you take that perspective there, to move into the no-no quadrant in which you have erosion on both, on both sides. If you take the more positive view on the multipolar element, especially if the two then in the system are interconnected, I think you have a 1 point there in your slides, then I think we can, in a sense, what we are doing now maybe prevent the upward arrow, from moving into that. Okay, so this was to nourish a bit the debate, summarize some of the things that we have heard. Okay, we now open the floor for questions, then Agnès will take the floor. I think we are rather late, so I would do one round. And then Agnès, if there are questions for Leonardo, also would take the floor. Okay, please, Tobias. Please introduce yourself, so also colleagues online.
Great. Tobias Pforr, I'm a visiting fellow at the Schuman Center here. Thank you very much for these fascinating and thought-provoking presentations. So basically, coming back to your title, I mean, it's a large question, but how do you think the digital euro fits into all of this, right? Because, and then sort of a second question, both for Europe, we've obviously privatized a large part of the payment system, but there's still substantial senior rich benefits, from what central banks do. So I only know the figures for the States, right? It's around $100 billion a year, which the Fed still pays to the Treasury Department. How worried are you about, privatizing that? And is there some serious thoughts going into how can we actually keep as much of senior rich public as is possible, even in a more digital system?
We have online also Shaheen. Hopefully it works. Shaheen, please try to see if...
Can you hear me? Does that work?
Yeah, we hear you well. Okay, welcome.
Thank you very much. I have two quick questions. One is whether the fact that there is such, for now at least, a limited holding limit for the digital euro, whether that's not a fundamental impediment to digital euro rising as a true means of exchange. And so I'm wondering if the trade-off that European banks seem to be concerned about, that the rise of the digital euro would cannibalize their deposit, is not a major impediment to see the digital euro's expansion. And I have another quick question on stable coins. We seem to have decided in Europe, in my view rightly so, but this is up for debate, that stablecoins were a substantial risk to financial stability, that they created par convertibility risk that we were not very well equipped to deal with. And yet, despite that, we have allowed, in particular in France, if I'm not mistaken, the convertibility between a US issued CBD stablecoin into a European issued stablecoin. And I'm wondering whether we're not taking the risk here of importing financial stability risk from US issued stablecoin onto the European market against the will of European legislators. So I'd love to hear you on that. Thank you.
Thank you very much, Shaheen. So you have heard the European and a macroeconomist view. Yes. Who? Okay. Okay, Thorsten then.
Just a quick question to Agnès. Does the European Central Bank think we should have a digital euro to substitute for stable coins, not end stable coins can lead to multipolar, because they see it as too big of a risk for financial stability, as Shaheen just said?
Thank you. A couple of comments. So first, I mean, again, I'm not a macroeconomist, I'm a financial economist, as you know. So my first question is always, well, why do we need stablecoins? Now, the nice way, the benign way to look at it is financial innovation. And maybe in a bank-based system, we need a little bit of competition to bring down the costs of banking. So that can be the good side. But I guess there's then the stability risk already alluded to. I mean, the money market funds were mentioned, which, I mean, the stable coins look very much like money market funds. I mean, there's of course a difference of being a shareholder, being a claim holder. But as we know, this, and as you showed the graph from the ESRB report, they are not really stable. So then the question is, what use do they actually have? And when you actually, I remember I asked actually once practitioners, what use case do you have for stable coins? And they had to think a while, and then they said, well, cross-border payments outside the euro. But as you also showed, there is not much of it yet. So the question is really, what do we need stablecoins for? And you could argue, given that the US payment system until recently was a complete disaster, I mean, much worse than our payment system, much more inefficient, maybe they need more innovation than we do. So that's one. Actually, on the payment system, I mean, a digital euro is not a CBDC, as we know. It's a payment system with this reverse waterfall. So there's a holding limit, but there's not a limit on payments. I mean, you can use the digital euro to send 20,000. I can use the digital euro for the most expensive lunch ever with Marco and send him 20,000 euros, which I won't do, but it's okay. It's just a reverse waterfall, meaning if I have 2,000 digital euros, I will send 2,000 digital euros to Marco and then 18,000 out of my bank account. And that goes through the digital euro account. So that's why they call it also the European paper. Which can also mean, so on the global level, I see the point of moving to a multipolar system. I'm not quite sure the stable coin, I mean, this goes to Leonardo, is really the mechanism tool that we even would like to use. And as you said, I mean, there are other things like fiscal sustainability, safe assets. I think that of course might also lead to the deep and liquid capital markets and so on. Now, coming then back to the Marco's graph, which I really like, and yes, I've seen it before and I remember where I saw it. I mean, this brings to the other point on the stable coins, the financial stability risk. Let's call it also vulnerabilities, right? I mean, in Europe, we depend on the MasterCard, on Visa. We have a couple of national payment systems. Not every country has one, but they are, if I want to send something from my Italian bank account to my Dutch bank account, it has to, again, I think it goes through MasterCard or Visa, because Bancomat doesn't talk to whatever the Dutch system is. So I think, and that's where I think the real problems lie, and that's of course where then Marco's graph comes in. So if the U.S. administration tries or attempts to or intends to weaponize finance, then Europe is in a big trouble. I mean, of course, I know that you guys in the Eurosystem, we guys at the ESRB have been discussing that, and it's a big concern. Now, finally, there was something on Shaheen I wanted to mention, but I forgot what it was. Yeah, so let's just not. Okay, thanks.
Thank you, Torsten. Colleagues online, we have many actually connected, so please show up if you like to intervene. There are in the chat, several messages. Mika does not explicitly envisage the joint issuance of stable coins by the EU and third countries entities, and therefore cannot address associated risks. Then the slides have been shared. That's not the
actually speak to that one. That was actually the point I want to make to Shaheen, because
I think that's okay.
That's exactly the point I wanted to make to Shaheen.
Yeah.
So this is what the ESRB recommendation that we came out with last Monday? I think, yes. Which comes back to the weaponization issue exactly, because as you had, Agnès, in your, I mean, you know all of this, of course. If you have this nice graph which you show the table with the comparison of the MiCA and the Genius Act, this kind of regulatory discrepancy, and then having stable coins that are issued both in the euro area and in the US or globally, and or by US stable issuer and European stablecoin issuer, and they're completely fungible, then you can have a problem where, let's say, because the Genius Act also allows to impose gates meaning then suddenly all of the non-European stable coins holders would come to the euro and try to withdraw their money from there, which of course then has a problem, a knock-on effect on the European financial system. Or similarly, the US might decide, you know what, Europeans, non-US citizens don't have, or residents don't have access anymore to the reserves that are behind the stable coins on our side. So I think that is exactly the issue, and that's why what also Shaheen mentioned, that is definitely a financial stability issue, which then some people would say, well, we need more international cooperation. Well, as we know, good luck with this one. So that's not going to. In the case of the US and Euro, I think that's it's a very, very tricky thing.
Okay, final opportunity before we give the floor to Agnès. I don't know, Leonardo, if you like so. No? Okay, then we give Agnès the floor for a round of response, and then we will adjourn.
Thank you very much. Thank you for all the comments, and especially to Leonardo. I share many of the comments, so I will only touch upon a few of them. Leonardo, so I never thought about the need to have safe assets if we want to develop stable coins in euro. It could appear as straightforward. However, there's another way to issue stable coins, which in my view would be more secure, which would be that banks themselves issue the stable coins against their own balance sheet, and given the fact that they have access to the central bank refinancing. And so we've seen I think two groups of banks wishing to issue stable coins, but apparently they are going to set a joint venture with a separate entity that would issue the stable coins in a classical way. So it's not exactly what we have in mind, although there could be some refinancing line, we don't know. If they have credit line, if the issuer has a credit line with the different banks of the coordination of the banks, then it could work like that. But I think it's a fair point. So on the possibility of non-sovereign digital currencies, this is exactly what we fear. And well, there was this story about Libra. It was Libra was it was not sustainable, it was not well designed, but it's coming back. And it reminds us, well, we were not born, but what we read about the 19th century, the before unification in the US, well, it was exactly that, with several non-sovereign digital, not digital, but currencies, and exchange rate between different dollars, which is not one. So you could have several stable coins issued by different issuers with different solidity, and then the signalness would not be insured, and also there would be a fragmentation of liquidity, which is not efficient. So how does the digital euro fit in this? So I try to make the point that we need to keep the contact point between commercial or private currency and central bank currency. And the digital euro is plugging one, because it's given the fact that the use of cash is diminishing, it brings again the link with between commercial money and central bank money at the retail level. And wholesale CBDC plugs the wholesale part. So this is a way to keep the system together. So in terms of seigniorage, so in a sense, banks do also earn a seigniorage, which is not called a seigniorage, but it's equivalent. But they are regulated, heavily regulated. And we ask them to circulate the cash, and we will ask them to circulate the digital euro. So it's a kind of a contract. So what is problematic is a non-regulated entity taking over the banks, which in a sense provides a delegated public service to the economy, which is of course much better carried out by banks than by governments. To Shaheen, and I think you already had the response to your two questions. I think the holding limits is not an impediment. You could even think about zero limit, and it could still work. And this is where I bring again the card. When you have a card, there is, in a sense, zero. There is a zero limit. You don't have cash. You don't have you don't have holdings in the card. Just a card will pick the money from your account to bring in somewhere else. It could be a bit of the same. So you can think of the digital euro as a substitute for the card, for the credit card. And there is a waterfall and reverse waterfall that allows full the money to flow, whatever the amount of the payment. And the convertibility between US and EU issued stablecoins. So this is where not everybody has the same opinion. I think the Commission is much more happy with the situation where there's fungibility between US issued and EU issued stablecoins. And you won't be surprised that the central bank is less happy about this for financial stability reasons. So we'll see what happens in the future. There will probably be a MiCA 2 and so on. Digital euro, is it to substitute stablecoins? I don't think so. I think the position of the Eurosystem is to say, well, we need all sorts of payments, and if stablecoins are useful for cross-border payments, for instance, why not? And digital euro has a domestic use. So you cannot bring your digital euro to the US or any other country and pay in digital euro. So I don't think it's really not at all a substitute. However, and this brings me to the final part of Torsten. So why do we need stable coins? And I very much like the idea that stable coins are especially attractive in those countries with less efficient payment systems today. Mm-hmm. I mean, we have a very well-developed fast payment system in the US. FedNow is not much used, and I was shocked recently in the US not being able to pay with a credit card and having to bring cash. Yes, so the payment systems are unequal, and I think it's like fresh air. We don't really see that we already have a very efficient payment system. One problem at the retail level is that we have a duopoly of MasterCard and Visa who have killed domestic providers, and so I think it's only in 5 countries in the EU area, 6 countries in the EU area where there is a national scheme, where 6 in the EU. 6 and 5 in the EU area. So meaning that if the US administration switches off the card schemes, the payments could still be done with cards in only 5 countries of the EU area. And only in the country, not cross-border, within the EU area. So for instance, in France, there is a national scheme. So it would be still possible for me to pay with my card, but not in Italy, which is a shame. We are in a monetary union, and we are dependent on foreign providers. And for the multipolarity of the international monetary system, I'm not so sure it's absolutely linked to stable coins. Or I think the interlinking of fast payment system has a long way to go. It's already the case in the EU, because probably you know that Denmark and Sweden have joined TIPS, so the EU area fast payment system. So now you can make a fast payment system cross-border outside the EU area to Sweden or Denmark. It will soon be also exchanged with the krone. And it's already also being cloned into some Southeast European countries, and the ECB is discussing with large emerging countries which are very well advanced in this area, like Brazil and India, to interconnect the systems. So at some point, even if you don't have a CBDC, you could move in the direction of a multipolar system, meaning that if I want to make a transfer to India, I don't need to go through the dollar. And so this is what is meant by that. And there's also a big, so in terms, and also the blockchain is not just for stable coins. It's used in other areas, nothing to do with finance or money. And there is a very interesting experiment at the BIS for compliance, because a big cost of cross-border payment is compliance cost, know your customer. And here you could imagine, so they are trying to test a compliance certificate on the blockchain. So when you, the certificate would travel with the payment, and it would be much cheaper and rapid. And this is not for the long term. It could be implemented, I think, in the next 5 years. Yeah, so I'm going to stop here. Thanks you again for your remarks. It's very it helps me to think of these issues, because we are still struggling with some concepts and some hesitations. For instance, we didn't talk about this, but if we have a wholesale CBDC, should be circulated only on public rails, or do we accept that they are circulated also on private rails, meaning public and private have opposite meanings. So for instance, Google rails. After all, cash can be handled by anybody. So why not a CBDC? But you have obviously some issues related to money laundering, related to financial stability, and so on. So we are not at the end of the journey.
Okay, thank you very much, Agnès, and Leonardo also, and everybody. I think it has been very fruitful. I mean, I had asked Agnès to be pedagogic on this matter, so going back to basics, and not because it's easy. You can see that to get on very complex technicalities. It's important for us in particular to go to the basics and to link a bit to the global macroeconomic reasoning. And as far as our work on the report is concerned, let's say to identify both inner and collateral conditions in order to shift to your second triangle, which is the one on the multipolar elements. And I think a number of issues have, a number of good suggestions have come up in the discussion. So definitely we have to pursue this in the next weeks and months. I would like to finish with just one more general reflection. And it is that if you take US versus Europe, I mean, typically, and here that's the more general, it can be on AI as well as other types of innovation. You have, in a sense, very light regulation in the US, if regulation at all, and then you unleash the markets and innovators, and then they say, okay, we try to regulate or temper the shortcomings ex post. The problem with that is that the dynamics of radical innovation, and maybe in this case also for this issue here, is that it creates the vested interest, which prevents at the end to correct ex post, because they capture the politics, And you can see the big bros, the crypto bros, in my initial quotes. They have already, captured Washington. So that is a shortcoming. So what we do in Europe, us being the children of ordoliberalism, we tend to regulate ex ante. No, we set the corridor, and then we try to, innovate within the corridor. The problem with radical innovation is that almost by definition you have to go outside the corridor. So maybe in this case here, if it is true that the welfare gains of going into that, on the stable coin path and the crypto, are probably not overwhelming. Maybe having set, a good corridor is in this case here, maybe the right thing to have done. So this is just to finish up on a very interesting discussion. So we thank again Agnès, and we adjourn to the next EMU Lab events. Thank you.